Almost 2 out of 3 households struggle to pay their mortgage on time. This means that if you're looking to buy a house, you will have more chances to have difficulties at paying the mortgage than not. And the reason why is very simple. Because most of the people take the maximum mortgage they qualify for. Because yes, it can get you a bigger and nicer house. But the reality is that qualifying for a mortgage doesn't really mean that you can actually afford it. And this is what leads people to struggle with their mortgage, increase their debt, and even lose their house. So if you don't want to be part of this group, let's see together how to understand how much money you can afford to spend for your house. And in the end, I will even show you a free tool that I created that will help you do that in a matter of seconds. But before going to see how to calculate that, it is important to understand that banks don't really care if you manage to buy your house or not. But this is not because they're mean. It is just that they are businesses that are trying to make money. And lending money is one of the biggest businesses of banks. This means that the more money they lend, the more money they make. And this is why they try to make as many loans as they can. Clearly, there are regulations about how much money they can lend to people, especially after the crisis in 2008. Because if you didn't know, the reason behind the 2008 crisis is that banks were giving loans to people without actually really looking at their financials. And this led to too many people not being able to pay the mortgage, which led to a crisis in the banking sector. So yes, banks have regulations about how and how much they can lend to people. But this doesn't mean that they will lend you just how much you can afford. Far from that. What they do is that they actually statistically analyze how much money they can lend you without exceeding a certain level of risk. But imagine that a bank that manages billions is giving you a loan of $500,000. That's peanuts for them. And so their level of risk is much different from yours, because for you $500,000 could be the savings of your life. And so it is extremely important to understand that this means that the level of risk that a bank can afford and the level of risk that you can afford is extremely different. And so basically, banks will always offer you much more money than you can actually afford. And this is why you should always spend less than that. Because remember, in the case you don't pay, they will just take your house, and so they will be fine, but you will not. So now the big question, how do I estimate how much I can spend for my house? Well, it isn't an exact science. There are many variables. How many savings you have, where you live, what is your income, what is the cost of your life, and then you also have many other things that you can't control, like inflation and interest rates. And so this is why we talk about estimations, because it is impossible to exactly say how much money you can spend on your house. But we can have rather good approximations or estimations. And to do that, we will see 2 classical methods and 2 that I would say more recent, which are actually my favorite ones and the ones that I would use. And so let's start now with the first classical method to understand how much house you can afford, which is called the 28-36 rule, where basically it says that you can spend maximum 28% of your gross income on your mortgage payments. So basically it means that if you're earning $100,000 per year, you will be able to afford at maximum $2,300 per month in mortgage payment. The second part of the rule says that your mortgage payment plus all the debts that you're paying must not exceed 36% of your gross income. So again, if you're taking $100,000 of gross income, you will have $2,300 for your mortgage, and in total, considering your debts, you can spend maximum $3,000 per month. But there's actually something extremely important to understand when you buy a house, because if you don't understand that, you will surely lose your house to the bank, because you will not be able to pay your mortgage. Because you have to remember that when you buy a house, the mortgage payment that you do every month is the minimum amount of money you will spend for your house. Because to that, you always have to add the maintenance costs, the insurance, the property tax, and many other things that you will have to pay for. And so as you see, this rule doesn't take this in consideration at all. And this is why I don't like this rule and I would never recommend it. So let's now see another rule that actually takes that into consideration, the 30-33 rule. And so this rule starts with saying that 30% of your gross annual income has to be allocated for your overall housing costs. And so in this case, we're including also the maintenance, property tax, etc., which is much better. And so again, with $100,000 of gross income, you will be able to spend a maximum of $2,500 per month in housing. Then we have the second 30, which is actually a great part of this rule, which says that you should always pay 20% of down payment, plus keeping a 10% as an emergency fund for your house so that you will always be able to cover your housing expenses in case you need some more money. And this is really good because it will definitely help you in the future. And also taking into consideration the fact that you have to pay 20% of the down payment, which is normally the maximum you can, is great because it will actually extremely lower the interest that you will have to pay over the time. So you should always pay the full down payment that you can. And so now let's go to the last part of the rule, which says that you should never buy a house that costs more than 3 times your annual income. But I have to be honest, it's kind of useless because if you make the calculations, 30% of your gross income paid for 30 years will be 3 times more than 3 times your annual income. So in the example, you can buy a house which price is maximum $300,000, but according to the rule, you will pay over 30 years $900,000. And yes, you have the interest, you have the housing costs and everything, but it's not gonna be $600,000. So this part of the rule, it doesn't actually make any sense. But now I have to confess you something, because these two classical rules don't work. Both have an enormous problem, and I'm talking about it because I don't understand how people that call themselves financial experts share these rules and don't talk about that. But well, I'm not here to bullshit you, I want to help you. And so I'm going to tell you what is the problem and so why you should never use these rules, because they will just lead you to make a huge error in buying your house, which could actually make you lose the house to the bank because you can't afford the mortgage. And the problem is that they consider gross income. It is as if you hadn't to pay taxes. And this is a super important aspect to consider, because if you're paying 30% of taxes or 40%, it makes a huge difference. And so imagine you did the 30-33 rule with a tax rate of 40% and you're still earning $100,000, so you're supposed to spend over the year $30,000 for housing costs, which is the 30%. But if you take your net income, which at a tax rate of 40% will be $60,000, it will actually represent 50% of your overall income, which is enormous. I mean, what if you have other expenses to cover? You will surely struggle. And so these rules don't take this extremely important factor into consideration, and that's why you shouldn't use them. And so to actually know how much money you can spend for your house, you absolutely have to subscribe to this channel, otherwise this video will self-destruct in 3 seconds. Okay, I'm kidding, but if you find this video valuable, consider subscribing to the channel. And so let's go back to the topic. The rules we just saw don't consider taxation. And this is why I would prefer to use a simple rule that I named the 30-30 net rule, which is very simple because it's like the 30-33 rule without the 3 that we said is useless. And you consider the net income. So the first 30 says that your total housing costs must be maximum 30% of your net income. And this will actually help you better manage your finances and you will never struggle to pay your mortgage. And then again, the 30% of the rule, so 20% down payment plus 10% to keep in case of need for housing costs. This is a great part that you should still do. And so in the example from before, with $100,000 of gross income and a 40% tax rate, you will be able to afford $1,500 per month in housing costs. And sure, it might look little and you can surely stretch it a little bit. I mean, that's just theoretical, but I'd personally rather buy a house that I know I can afford and that I will keep, instead of having a house that will put me in debt and that in the end the bank will take back. But it is true that all of these rules don't actually take into consideration many aspects of your financial life, for example your savings and your living expenses. But we can do that, and I've made a free tool that makes it easy. To do that, we actually have to use what I call the backward method, where basically you estimate and consider your expenses as well as your income. And thanks to that, you can actually see how much money you can afford to spend for your house, or the other way around, how much you should reduce your expenses to have the house you want, or how much you should increase your income to have the house you want. And it is true that it might look difficult, and this is why I made a super simple tool so that you can do that in just a couple of seconds. And the great thing is that you also can see all of the other rules that we discussed in this video so that you can make a comparison. So let's rapidly see it together. So here we are on the simulator, and here we can see the different inputs that we have to put, and we start with the gross income. So if we consider the case we were discussing, we'll put $100,000, tax rate we said 40%, estimated interest rate, in this case let's say 4%, and yearly savings dedicated to housing. So this actually means how much money you want to put every year from your savings towards your house. So maybe that it's not coming from your income, but that you still want to dedicate to it. And here in this example, for let's say, for example, $10,000, but clearly you have to adapt to your own situation. Yearly cost of life. This is how much living your own with your lifestyle actually costs you. And let's say in this case is $40,000. And finally, how much of the money left after living expenses do you want to use for your housing? Because let's say you have your gross income, you pay your tax rate, you have your net income. Let's say that you remove the $40,000 of cost of life, so from your $60,000 of net income, you will have $20,000 left for other stuff. And this means maybe that you want 70% of that going towards a house and the other 30% maybe just going to savings or investments. So let's say 70% for example. And here actually you can find all of the rules, the 28-36, you have the 30-33 rule, then the 30-30 net rule, and already just checking the tree, we can see a big difference in terms of monthly mortgage payment, because yes, you can find out, as well as the monthly housing cost, the house price that you can actually afford with the rule, as well as the down payment that you have to pay to cover the 20%. And finally, you can also find the total housing costs over 30 years. And this also gives an important indication of how much money you will use over the time. And clearly we see here that between the 28-36 rule and the 30-33 rule, there's not that big difference. But if we consider the 30-30 net rule, since it is considering the net income and not the gross income, which again, it's better, it's safer, the amount of money you can spend for your house will be lower. But now let's take the backward method, because most of the parameters you entered are for the backward method, as you can imagine. And this is actually very dependent of them, because for example, in this case, we see that you can only afford $1,200 per month over housing costs. But clearly, if your expenses are lower, for example, at $30,000, the other rules won't change the result, but the one from the backward method will drastically increase, as well as if you decide to put 90% of your remaining money towards the house, again, you will increase again, and it will be at $2,000, for example, for the monthly mortgage and $2,000.3 for the housing costs overall. As well, I've also added a little part here where it says monthly money left. So taking your income, your expenses, and if you remove the housing costs, what will you have left to do other stuff? And this is the money here. For example, in this case, it's $250. And so this tool is made it super simple, as you see. There's really nothing complex about it, but it gives a good idea of how much money you can spend on your house, and especially this backward method, it's extremely important because it gives you a much better estimation of how much money you can spend according to your own situation, which is extremely important because we're all living different lives and our needs, our costs are different. So here is the crude truth. You actually thought that you could afford a bigger and nicer house than what you actually can. Sure, this is theoretical and you can surely stretch a little bit these numbers in order to afford the house that you want. But you have to be careful because I'm sure that you don't want the bank to knock at your door and tell you that they have to take your house back. And the best way to avoid that is to have more money. And how do you do that? Well, you make more money. And to do that, you just have to watch this video. Thank you for watching and see you soon.